Today's top picks from Reuters Breakingviews. More room on the upside. Asset allocators should hold their nerve in the wake of the summer rally for global equities. And why urban real estate may not be such a safe haven. With me now is Reuters Breakingviews assistant editor Robert Cole. Robert, thanks for joining us.
Pleasure.
London and Hong Kong prime real estate prices are just going through the roof. And Peter Tal-Larsen nails it when he said, it's as if the financial crisis never happened. Are investors really that foolish or naive?
Well, it all comes down to a question of supply and demand. I mean, I know that relationship isn't seen as the sort of hard and fast law as it once was, but people, for one reason or another, really want to buy property in these very prime residential cities such as London and Hong Kong, and that means that the price has gone up, and that means that the value there is very, very hard to see. As to Peter's point about it's as if the financial crisis hasn't happened, very, very good point. Very well put, but I think it also suggests that, as with any crisis, it's not all-encompassing. Not everybody gets hit, Basically, the averages, might go down. There might be some very, very badly affected people, but I think this also shows us that actually, even despite the depth of the difficulties, there are enough people with enough money, despite all the difficulties.
More money than sense, one might say.
Well, to spend it how they wish, you might also say, and to force prices in these areas up. But I mean, the obvious difficulty, and the one that I think regulators or policymakers have to address, is that they still need to have affordable housing for everybody who lives in a city, not just the people who are pumping the prices up.
$55 billion for one apartment, is that right? Was that in Hong Kong?
I can't. $55 billion for one apartment?
Maybe the billion should be million.
Or maybe it was a very, very big apartment and it was for the whole thing, perhaps, apartment block.
But should we be concerned because, I mean, obviously the roots of this crisis, many would argue, are in the property crash in the States and elsewhere. Should we be concerned if these prices continue to rise and then tumble down again?
Yeah, of course we should be. Of course we should be. But as I think this piece that Peter's written is quite localised in some quite sort of some very, very sought after centres. I think that the issue with subprime lending, of course, was that prices across a whole market and then in some pretty rubbishy areas, for want of a better description, were rising way beyond their intrinsic value as well. Okay.
You say in your second piece, investors should, quote, hold their nerve. By that, do you mean they should just not sell?
I think they should actually continue buying, in fact. And I think that one of the features of this whole crisis, actually, is that for those who are prepared to take a longer-term view and have a basically optimistic outlook that in the end everything will be all right, this is the time to be buying. Do you know why? Because prices are cheap. The worst time to buy was at the height of the excitement in 2008 or 1999 when prices were very high.
The S&P is at a 4-year high. Is that the right time to buy, given everything that we know is going on?
It's at a 4-year high, but it's also at a value if you in terms of earnings, which is below average. Actually, I would say that the S&P is one of the markets where there is a less glaring value play. I think there's probably still some value, but it's not like very, very obvious. It's there is obvious value in Europe. They're trading at like 50% below their sort of long-term valuation averages, but they're clearly, as you're perhaps just about to say, some very good reasons for that. I guess the point of writing this is that there has been a strong-ish summer. It's been in thin volumes. There has been some widespread thoughts. I think we may have even discussed it here that this is something of a phony uplift, and I see all that. But I also see that actually the thing to do here is to hold one's nerve if one's that long-term investors and see through what might be some near-term reversals. One of the key things I refer to in this piece is whether we're going to get some new extraordinary or emergency measures from the central banks, and that's possible. I actually think that it's less likely because I think that the bankers are beginning to think that they need to wean people off them. But markets shouldn't be wanting these kind of emergency measures because it's clear
of how bad things are. The fact that they need that fix.
Absolutely, which goes back to my other point, which is that my instinct is that if markets are depending on these emergency measures, they may be disappointed. But that in itself should be a good thing, if you know, see what I mean.
I'm sure we'll follow this up after the ECB meeting on Thursday.
We'll get a better clue as to how things are going to pan out after that, for sure.
Okay, Robert, thank you very much. My thanks there to Reuters Breaking Views, Robert Cole. There's more Breaking Views on Reuters.com and the Insider platform, and join us at this time throughout the week for more incisive commentary. I'm Jamie McGeever. This is Reuters.